Welcome to everybody to my lecture. Just we are following this book. This is Accounting Principles, Weygandt, Kimmel, Kieso, 12th edition. Now we are going to discuss our chapters. The chapter names Accounting for Merchandising Operation. This is learning objective 4. Apply the steps in the accounting cycle to merchandising company. We know that we have an accounting cycle, and this accounting cycle we have some points. This is adjusting entries. This is one point of accounting cycle. Okay, so generally the same as service company. That means this one is generally as same as service company. Number two, one additional adjustment here. That means this is actual inventory on hand. How much inventory on hand? Just we need to be recorded this. Number three, it involves adjusting inventory and cost of goods sold. Now adjusting entries illustration. Suppose that PW audio supply has an unadjusted balance $40,500 in merchandising inventory. Through a physical count, PW audio determines that its actual merchandise inventory at the end at year end is $40,000. The company would make an adjusting entry as follows. That means we know that the unadjusted 40,500 and actual merchandise inventory at the year 40,000. Here cost of goods sold, debit, and inventory uh, uh, credit. That means just actual merchandise inventory at the year end is 40,000 and unadjusted balance 40,500 merchandise inventory. So here this would be the adjusting entries, cost of goods sold and inventory. That means cost of goods sold debit, inventory credit. And now closing entries, it's an example. When we close the entry, the sales revenue will be debit, okay, and all expenses will be credit. Uh, Actually sales revenue always credit and all expenses always debit. So here when we close the entry end of the year, that times we know sales revenue will be debit and income summary would be credit to close income statement accounts with credit balances. Okay, now income summary, debit and all expenses will be credit. Actually we know that all expenses are debit, but when we close the entries, that times it would be credit. That means sales returns and allowance credit, sales discounts credit, cost of goods sold credit, salaries and wages expenses credit, freight in, advertising expenses, utilities expenses, depreciation expenses, insurance expenses, to close income statement accounts with debit balance. That means when you close the entries debit with debit balance, we need to be closed the entries. I think everybody is clear now. Income summary debit and owner's capital credit. Here we can see that one point. The point is 4,80,000 the sales revenue, and this income summary credit 4,80,000, and here income summary debit 4,50,000. So income summary credit balance we have seen that 30,000. That this 30,000 must be a capital balance. Okay, that means owner's capital. It could be loss. It would be loss. That times income summary. Suppose here not 4,50,000. Suppose this is 5,10,000. So 30,000 that times would be loss. Okay. And drawing, we know that always drawing debit, but when you close the entry, the drawing must be credit, and owner's capital could be debit. That means here owner's capital debit 15,000. So here the trial balance of Celin's Sports workshop at December 31st shows inventory $25,000, sales revenue $1,62,400, sales returns and allowance. This figure sales discount, cost of goods sold, rent revenues, freight out, rent expense, salaries and wages expense. Prepare the closing entries for the above accounts. So here we have revenue, sales revenue and rent revenue. The revenue, actually in our general sense we treat this revenue as a credit, but here would be debit. Sales revenue and rent revenue. And income summary would be credit. And another one is expenses. Here we have a lot of expenses. Suppose here sales discount, sales returns and allowance, cost of goods sold, rent revenue, sorry, freight out, rent expenses, salary wages expenses, all will be credit here. Cost of goods sold and this one, all are credit here. Okay, I think everybody is clear. Thanks to everyone to attend this session. Thank you so much.